Thank you. Hi, I'm Zach Summerscale. I'm Chief Investment Officer at Babson Capital in Europe. Delighted to welcome a very esteemed panel today to discuss Europe. I thought it was very interesting in the first panel today where Europe was hardly mentioned. If we'd have gone back 2 years, I don't think anyone would have been talking about anything other than Europe. And even last year, 40% of people thought Greece would leave the EU at last year's conference. So clearly, there's been dramatic changes of events, and we will discuss about whether the markets are too sanguine or not about what we think about Europe today. I'll start on my right. We have Andrew Goldberg. He's an executive director at JP Morgan Asset Management. Peter Guenter, immediately to my right here, who is executive vice president for global commercial operations at Sanofi. On the left here, I have Yann, who is an executive managing director for S&P. Keith Savard is next to him, a senior managing economist at the Milken Institute. And last but not least, Howard Shaw, who is executive chairman of Shaw Capital. I guess I'd like to start with you, Andrew, in terms of, I mean, is this the European crisis over, or are we currently in the eye of the storm, particularly given current situation in Italy, which again the market seem to just be ignoring?
You know, Zach, it's an important question, particularly for investors. The crisis in Europe's not over. It's ongoing. And I think one way that I often frame it for people is just to remind people that what needs to be achieved in Europe, and many of us know this, is greater integration in the banking system in terms of political unity, federal and fiscal unity, and that can take many years. It took the United States of America some 200 years to achieve it. And it's not to say that this will take 200 years, although I know some of you guys think it may take longer. But it's not over. What I would point out, and I know that we had submitted some slides, slide 4 in the deck if we've got it, is that we have moved a year or two ago from a period of contagion to one of containment, and that's the key thing. You can solve problems as long as the crisis is no longer at a boiling point. And so that's what you need to start to see now is work needs to be done to take advantage of the fact that the European Central Bank has acted to contain the crisis and start to implement, I think, new, whether it be new laws or new steps towards improvement. And that has to come from fiscal policymakers. The European Central Bank can't do it all alone.
Okay. Peter, I mean, from a commercial point of view, are you sanguine about Europe today, or are there still concerns from Sanofi?
Well, actually, as an industrialist and also working for an industry which, of course, is somehow dependent on public spending because of the way healthcare spending is organized in Europe, we're actually extremely concerned. We have come in the eye of the storm of what I would call the fiscal consolidation policies of the governments, with severe impacts on the overall healthcare spend and then within specifically on pharmaceutical spending. And we are coming nearer to a point where we will start to see impacts not only for us economically, but also for the way European patients get access to innovation. And perhaps I could show you slide number 8, if you could put up slide number 8. Actually, we shouldn't forget that in the last couple of decades, and if you look only to the part of the right, that access to innovative medicines has indeed generated an incredible gain in life expectancy. Now, life expectancy is a very crude, let's say, factor to measure efficacy of a healthcare system. You have much more sophisticated ones like quality of life. But the fact of the matter is that this picture might start to change if we continue to feel the pressure only of the austerity policies. And this is exactly where we are. I think that lots to say. If you could also show slide number 9, which is a little bit of a collage of what we see coming as the social cost of this austerity, and I could also speak later on the economic cost of austerity. But also, if you look at the social cost of austerity, what's happening today is that patients who need access to innovation no longer get it. It's worse in some countries than in other countries. But as a general rule in Europe, we are really at this crossroads. What do we want to do? Do we really want to invest in healthcare because of social reasons, but also because of economic reasons? Or do we just continue year after year to slash down under the, let's say, the primum movens of fiscal consolidation, and then in a couple of years come to the constatation that we actually jeopardize the European ancrage, the European centered way of big pharmaceutical companies?
Okay, thank you. Howard, as someone who's not noted for their liking of the EU as an institution, do you think we're now through the worst from an EU perspective, or you still think there are troubles brewing?
Well, of course, the crisis is not over. However, the major recent development is the re-election of Angela Merkel with a very high percentage of the vote and a strong endorsement from the electorate. I think she's pretty much the first major European leader to be re-elected post the crisis. And I think that tells you that the German public are prepared to support what I believe is an economically crazy route but for political reasons, of bailing out Europe. So I think she's committed to keeping the European dream together, and she'll do everything in her power to continue that. So I still believe at some stage the dream will end and some of the countries will need to leave, but it could be a long time in the future. Probably the Germans will need to reflate in order to support the efforts to keep Europe together. It's the only way that they're going to get the European economy moving, is to spend some money. At the same time, European countries are going to have to restructure their labour markets very significantly if this process is going to survive for any period of time. They'll also probably have to reverse some of their energy policies, which is, of course, in Germany, suicidal, getting rid of nuclear. But I think this whole idea of wanting more green energy is too costly because our energy costs in Europe are too high relative to America. Germany's energy cost is 3 times that of America. So we need to restructure labour markets. We need to reduce energy costs, and we need to see the Germans reflate if there's any chance of the process continuing for a long period. I think Germany will do everything they can to continue it, but I still believe in the end it will unwind.
Yann, are you as optimistic on the EU process?
I think there are two types of issues. There's the state of the EU economy and the state of the Eurozone, which are two distinct problems, but with very clear interaction. Starting with the state of the European economy, our chief economist came up with his latest forecast for the EU, and basically what we believe is that we're in a phase of stabilization, which is good, after the worst recession that the EU has been through for more than 40 years. But we're not out of the woods. And the EU as a whole is not out of the woods. Because in order to have a sustainable recovery, you've got to have basically 3 elements in place. You've got to have consumer spending, which is something that is still weak in almost all European countries. You've got to have exports driving that recovery. And apart from a couple of exceptions, export performance across the EU is still fairly weak. But even more worryingly, there's a third leading indicator for a sustainable recovery that is missing all across the EU at the moment, that is corporate investment. And if you look again across, including in the UK, the level of corporate investment, it is still coming down, which bodes ill for a sustainable recovery. So at the economic level, there has been stabilization, But clearly, the path to a sustainable recovery is not there, which opens the way for some downside risks along the way, and probably for a certain period of time. To give you an idea, we forecast for the EU at the end of this year minus 0.7% decrease in GDP, followed by a plus 0.8% growth for 2014 and only 1.3% growth for 2015. So that gives you an idea of the real lack of economic growth. And if we want to sustain corporate investments, and that will be another area that we will be discussing, will be through how do we make sure that there is funding that goes to corporates, including mid-sized and small companies, number one, and second, infrastructure spending. A few quick words on the Eurozone. That's a different issue, which of course has an impact on the European economies, but for the Eurozone in large part. And let's say that since summer of last year, where President Draghi made his announcement around outright monetary transactions, the contagion risk or the risk of the Eurozone blowing up is something that has been severely discounted by the financial markets, who now have been operating under the assumption that whatever happens, the Eurozone will stick together. But that doesn't mean that the fundamental issues of the Eurozone have been solved. And a month before President Draghi made his statement, President Van Rompuy, who's the head of the Union, published a document co-signed by all the heads of government called Towards a Genuine Economic and Monetary Union, which sort of says that actually before then there was no genuine monetary and economic union. So part of what we're seeing now is efforts to drive towards this genuine economic union, which includes the single banking system and more fiscal alignment between the various Eurozone countries. So we're in that period of, on one side, the big question is how do we make sure that funds keep getting channeled to the real economy, and on the other side, solving the problems of the architecture of the Eurozone.
And Keith, as an economist, are you seeing green shoots? Do you think you're seeing optimistic signs out of the European Union at the moment?
Well, I think when you looked at when we assembled a year ago, the discussion very much centered on who was going to leave the Eurozone. And we actually did a show of hands of the audience, and at that time, roughly 40% of the people thought that Greece would exit the Eurozone by the end of last year. And this came even after the announcement of outright monetary transactions by Mario Draghi. And I think now we're probably in a period of complacency and also a holding pattern until the German elections took place, and now we have to wait for the formation of a government. And I think on the backside of the storm, there's still a large element of political and policy risk that still exist. And also, there'll be a fair amount of deleveraging that still must take place. And that makes it very difficult for growth in the presence of green shoots.
Okay, thank you. And Peter's made some very good points in terms of austerity and the belief that there's maybe a false economy in terms of healthcare. Do we believe generally that austerity is the right path for Europe? And if it's not, then how's the best way to tackle the kind of the debt to GDP issues that you have across the EU zone today?
Yeah, I mean, I'm happy to tackle that one. The fact of the matter is these countries, and especially in the periphery, need some form of fiscal consolidation. They need to get their fiscal house in order. They need to pay and collect taxes. I was on holiday in Greece this summer, and the aversion to using credit cards was astonishing. But if you go to, and I've got slide 5 if you want to pull that up, austerity in and of itself will not work. And this is why. And it's a little bit hard to see, but The dot that I have circled, and just real quick what you're looking at, on the bottom of the chart, the axis that goes from left to right is debt to GDP. That's the problem in Europe that needs to be addressed, okay? The axis that goes from bottom to top is deficit to GDP. And what you're looking at is every country from its peak level of deficit to where the IMF thinks they'll be by the end of 2015. And so, for example, what you can see is that Greece, in theory, will have achieved a reduction in its deficit, all at the expense of spending cuts, which reduces GDP. So just keep in mind the ratio, debt over GDP, right? GDP is getting cut, so that's getting smaller. And they've reduced their deficits from, call it, 8% of GDP all the way down to 2, which is impressive. But there's still some left over. There's still some borrowing that needs to be done. Now, every year, the deficit that remains gets added on top of the existing pile of debt. So the debt in debt to GDP goes which way? Up. So if debt goes up and GDP goes down, you can't solve a debt to GDP problem doing that alone. Any economist will tell you that. And that's what's been so frustrating watching this thing. So to answer the question directly, is austerity the right way? No. But you have to do some of it. What you need to see now that the German election is out of the way, hopefully, is some form of pro-growth policy. Because like I said before, central banks can't do it all on their own. What's the right mechanism for that? I'm probably not qualified to answer it, but it has to emanate from Germany. And just real quick, one last thing on the very next slide. Each one of these bars is a picture of the dependency of these various countries on exports. The biggest one, all the way on the bottom, you can see that 40% of German GDP depends on exports. And the biggest single chunk of that is to the Eurozone. And so if there is any doubt about Germany's appetite to sustain the monetary union, where everybody is on a level currency playing field to buy Porsches and BMWs, put that out of your mind. They'll keep it together. But I also think that this chart's behind why Germany is ultimately going to relax austerity and move more towards pro-growth policies. That's my view on it.
Look, can I say, I don't think the German policy is driven by economic needs. It's driven by political needs. It's not a business model to sell cars to Greece, lend them the money, and not expect to be paid back. So I know the export industry in Germany would promote that because the industrialists have got a self-interest in doing it. But net, the economy is worse off because they're lending money to people that they know are not going to be repaid. I do agree with you, as I said earlier, that Germany needs to reflate. But coming back to the question about does austerity work and is it necessary, the key point is not just whether you're growing the economy or shrinking the economy, but the size of the government sector. In Northern Europe, not Southern Europe, people pay too much tax. You don't necessarily have to deflate the economy just because you reduce government expenditure. You can also reduce taxes. And the problem is that in Northern Europe, people live off welfare. They're too dependent on welfare. They're too dependent on social services. We need to reform the Northern European economies and shrink public sector and let the private sector grow.
And by the way, one interesting thing, being an American and moving to London, I've been stunned to see the degree to which the problems in the US and in Northern Europe are the same. There's a lot of social spending, and to make the math work requires changes. We've promised a lot of people a lot of things, and now it's no longer affordable. The irony, though, is any one of us can stop by the coffee bar after this and solve the problem on the back of a napkin. The academic problem isn't that hard. It's just politically, to your point, it's tough.
Agreed.
Yeah.
So if we don't agree that spending's the right way, then how do we foster growth in Europe? What do we think the mistakes that have been made, and how do we think the EU should grow its way out of this if we're not going to do it by spending cuts?
So if I may, and again with the view of a pharmaceutical company who at least today is more dependent on public spend than on private spend. Now that's a different discussion. I mean, There's a lot to say for a structural reform in the way or the balance between public spend and private spend for healthcare provision and pharmaceutical provision, but that's a different debate. I think that what Europe should be doing, if I follow what you say and say, well, austerity is probably rather a poison pill than anything else, it should really choose and pick, I think, those industries where it believes that Europe has a role to play 5, 10, or 15 years down the road. And typically, pharmaceutical industry is one of those industries where you have a high added value per employee, you have high-tech industry, and this is the industry in which we can continue to compete with the Chinese or with even the Indians in 15 or 20 years down the road. When you talk to European politicians, whether it is in the Commission in Brussels, whether it is in the member states,
and you guys do,
and we often do. I think the concept is absolutely agreed upon. I think they fully understand, and then comes the time where the words have to be converted into deeds, and there's a complete disconnect. So we have countries like the UK, France, who have really put pharmaceutical industry at a kind of, top industry for the next 10 years. And then comes the budget exercise, and then you really see that they are doing just the opposite. So the question to me is really how to compensate for this disconnect, and I can show you one slide on number 11, please, where you really can see the direct correlation when you talk about growth, and at least where public spend could help stimulating productive Europe. You remember the previous slide I showed you where, improvement of quality of life, prolongation of life per se. I mean, that's the good news, but it also means that you have a lot of people who will become chronically ill, who will have some kind of disability during their life. And it triggers also the question on productivity of labor, of workforce. And if you look at this slide, for example, you can see that in certain countries, and here I'm talking about mature countries, that up to 6.7% of GDP is lost on a yearly basis due to chronic illnesses, right? So if you can really unlock the value of decreasing that factor, you get a tremendous positive leverage on economic growth by better prevention, by better treatment, and by keeping the labor force fit, and also by working on the concept of healthy aging, right? We all have to work much later than in the past, much longer than in the past. So we have, as an employer, we have all interest that our employees remain fit longer and remain more productive. And there, innovative healthcare has a major role to play.
Clearly, we need to foster growth in the EU. And what do we think, Yann, what do you think kind of the mistakes have been made? Why don't we see more inward investment into the EU in this environment?
Well, one thing that hasn't been mentioned so far is the state of the banking sector in Europe, where we haven't really managed to break the link between sovereign risk and banking risk. And this is the whole purpose of the single banking union, but it is going to take some time. And if I compare the European banking system with the US, very clearly the big difference is that the banking system in the US being only one, straight after 2008, the US authorities forced the banking system to recapitalize itself. Putting that issue aside, that helped the economy to come back, because once all the solvency uncertainties had gone away about the US banks could start again to fund the economy. In Europe, the situation was completely different. Because the approach was piecemeal, because there were lots of vested interests at the national level not to be disclosing the full extent of the damage done by the crisis to the balance sheets of the banks. We're still in that period where, from an investor point of view, there are still lots of risks around the banks themselves. That's the first point. The second point is that on top of that, you've got a regulatory agenda that is being driven forcefully, that goes in the right direction, but is slightly pro-cyclical at this point in time, and that forces the banks to deleverage. And more often than not, they both deleverage and they reduce the size of their balance sheets. So now they've got to choose where they land, And it happens that lending to the mid-sized or smaller businesses is not where they want to place their bets, because the regulatory reforms tend to disincentivize the banks to do so. So one of the real problems we see at the moment is the lack of organized solutions outside the traditional banking sector to fund the economy. We see, and I think there's an interesting slide, I think it is slide number 25, that looks at what is called the high-yield bond market. High-yield bond market is basically those companies that tend to belong to more cyclical sectors and fall under what we call the non-investment grade category. In the US, this is the biggest chunk of the corporate sector because the US economy is actually largely disintermediated. In other words, US corporates get funding, the majority of them get funding from the markets, and that is through what is called the high-yield bond market. What is interesting is to see that since the beginning of this year, we've broadly reached in Europe the same level as last year for the whole year, which means that an increasing number of European corporates are directly tapping the capital markets alongside traditional bank lending. But if you look at the average size of the US and the European economies, they are roughly the same size. And you see that the US market is more than double the size of the European market. So that gives you an indication about how far the European market could go and European corporates could go into diversifying their funding away from what remains a struggling banking sector.
Indeed, so but part of the regulation clearly is trying to get risks priced properly. So do we feel that actually the regulation isn't achieving that goal, or whether actually this is forcing banks into doing what they should have been doing in the first place?
It is, but remember that this is happening at after the worst recession in 40 years. So it's more about the timing. It's not about whether the regulatory changes are legitimate. They are. It's about the timing of all this, what is often referred to as pro-cyclicality. So it's finding the right balance and making sure that at this point in time, the economy is properly funded and that Europe moves from a bank lending model towards a much more diversified funding model.
Okay.
We're certainly seeing, I agree entirely, we're certainly seeing mid-sized companies increase their demand for issuance through the markets, and it's an emerging market in Europe and the UK. Bond issuance amongst these sorts of companies is growing rapidly. Of course, that doesn't help the small companies who still rely on commercial banks. And on the left-hand side, the government's trying to push the commercial banks to lend more to small companies, but on the right-hand side, they're squeezing regulatory capital requirements. You can't do both at once. So I think the trend in the US that we've seen from the US come to Europe will continue very strongly, and that's very, very healthy, but we still need to address the shortage of capital for small companies.
And how do you think we best address that, given clearly there needs to be deleveraging at banks today, given the risk asset profile?
Well, I think the point was made that the Fed made the US banks recapitalize early. We didn't. That's a problem. I think lending criteria are still pretty strict. I don't see any short-term risk of over-aggressive credit policy, and therefore I would slightly relax regulatory requirements on the banks if you want them to lend more money. It doesn't mean you can't reverse that 2, 3, 5 years down the line.
Okay. Can I just make one comment, by the way, on this very issue? One thing that's actually hampering lending, ironically, in my view, is the Federal Reserve and the Bank of England's policy of forward guidance. So the idea being you're supposed to keep rates really, really low so that it makes money more attractive to borrow, so you'll go buy a car or a home. But the problem is, if I found out that a car that I wanted was on promotion or on sale for 20% off, and the sale was over on Sunday, I would go have a conversation with my wife, which would be required, and then I'd rush down and get it. But if the central bank or if the car dealership told me that the sale on the car is 20% off, and you better hurry on down because it ends in 2016, which is what they're doing, then you don't rush and do it. And so that is one of the reasons why I think there's a slide in here from Milken that shows the transmission mechanism is broken, meaning you can lower rates, but the money's not getting to the economy. And one of the reasons is, if I'm a potential borrower, what's the rush? They've got to lay out a path, I think. Central banks need to lay out a path for the banks towards eventual normal monetary policy. I just don't think the forward guidance thing serves the interests of the broad economy. I think it sets a... By the way, one thing that's interesting is you're seeing in the United States, now that rates are starting to go up, a sudden fire lit underneath potential home buyers and vehicle buyers to go out and do it now before rates go even higher. So I think once you lay out that path towards normal, you can get the wheels moving in the right direction, so to speak. That's kind of a controversial view, though. I don't know. Some people disagree with me.
And Keith, in terms of, there was an interesting comment made earlier about vested interests. I mean, what from an economics point of view do you think they should be doing? And politically, do you think they can get there in terms of the EU being a disparate group of countries still?
Well, I think from the austerity point of view, it's very clear that it's had devastating impact in Europe. I mean, when you look at growth in the Eurozone and Europe in a broader context, it's still below where it was before the crisis started. And for some countries, it's 20% below in the case of Greece. And people, sort of the Keynesian, neo-Keynesian school would argue that you should have more spending. But for the government perspective, I mean, when you have high levels of debt and large fiscal deficits, it's very hard to sort of reconcile that with higher spending. So it's really difficult to say how that this can be, sort of gotten out of this box.
We've always said in all our sovereign analysis that austerity in and out of itself is self-defeating. But for those countries that made the political decision to belong to the Eurozone, they've got to face certain constraints. And if you look at the first 10 years of the monetary union, you'd had some disparities that developed within the Eurozone that were not sustainable. In other words, you had Germany, who'd done some significant cost of labor deflation, and one starts only now to realize the extent of how labor was repriced in Germany 10 years ago. And at the same time, you have, broadly speaking, Southern Europe, in particular Spain and Italy, that were going the other way, where the cost of labor was going up dramatically. And in a monetary union, you cannot have this level of disparity between various countries. And this type of loss of competitiveness from Southern Europe has to solve itself out over time, and the only way would be for the creditor countries to bail out the other countries. If there is no convergence of all those Eurozone economies towards slightly similar levels of competitiveness, it's not sustainable. So austerity as is being recommended and advocated by Germany must be understood as, well, we've done our homework. We will help you out, and the creditor countries will start helping you out once you do your homework, which unfortunately has to go through some internal deflation. That has been happening. If you look at Spain, Spain is quite a good example where there's been strong repricing of in the labor market. But going through only austerity over time will be as self-defeating as allowing such divergence in competitiveness across the Eurozone that was allowed before, and we know now that this is not sustainable. So the governments are treading a very fine line. Austerity means addressing divergence in competitiveness between the Eurozone countries, but also over time rebalancing between creditor and borrower countries. And you can imagine that this is not something that happens in a day. Hence the fact that, as I often describe it behind closed doors, when people ask me about EU and more specifically the Eurozone, I say it will be long and painful.
So do we think we need increased fiscal transfers from the rich to the poor countries within the EU zone? And is that politically acceptable? Or can they survive? Can the likes of Greece and Italy survive with very high debt to GDP, very high unemployment, or Spain, 50% youth unemployment?
Over time, it's impossible. They can't. If you project numbers, even 10 years from now, this is not sustainable. But that's the reason why, in the meantime, other solutions will have to be found, provided that the creditor countries take comfort from the fact that some reforms the right reforms have taken place in those economies to restore their competitiveness.
But that means more centralised planning from the EU in terms of more kind of homogenous markets.
Fine, but at the end of the day, it's a political decision from each of the sovereign governments. I mean, if they all signed up on a document that talks about towards a genuine economic and monetary union, I suppose there was some agreement there.
Howard made an interesting comment back in the room before we came out about another more controversial solution to some of these.
Well, default.
That sparked a little bit of a debate back there.
Look, the one route is default. Another route is devaluation through leaving the Eurozone. And the third route is reducing wages to become more competitive. The problem is, and I agree that Spain is a great example where in the private sector, wages have seen significant reduction. But that's in the private sector. You can't have a situation where wages fall in the private sector but not the public sector. Already, for instance, in the UK, public sector workers earn on average more than the private sector. They also take longer holidays, more days off sick. They have better entitlements, and they have better job security. Now, imagine private sector wages were falling in that environment. This disparity would become unsustainable. So governments at some stage have to tackle the really pressing issue, which is the state needs to shrink, wages do need to come down if you're not going to devalue. At the same time, Germany needs to reflate. And these countries need to become more competitive or default.
Is that the view shared by the panel?
I don't think it's controversial at all. It will be long and painful, and there will be a mix of all that, probably. As to any country leaving the Eurozone, well, I don't think that's but there are different ways to do that. I mean, there's already been, even the German finance minister, even before the election, mentioned that they may be prepared to do something with the Greek debt. Yeah. That's likely to be a mix of everything. But back to the issue of solutions to funding the economy. There's also one area that hasn't been mentioned yet, that at this point in time is completely dead in Europe since the financial crisis, that's securitization, which not in London but on the continent is pretty much evil still. And to some extent, the baby has been thrown with the bathwater with securitization, because one way to fund the economy would be to repackage lending, some small lending amounts done by the banks to the private economy into structured vehicles that could go on to the market. This is what used to be called CLOs, and those CLOs do not involve any type of fancy finance as we saw up until 2008. This is, very traditional securitization, which could be a way to channel more funding into the economy, because banks would not be obliged to keep those loans on their books. They would still originate the loans but could get them refinanced by third parties in the market. We see an uptick in those CLOs, particularly of SMEs, but it's still very timid, very, very early days. And that's one of the solutions that could be found. And I take comfort from the fact that the European Commission itself has said recently that they viewed securitization as one of the ways to channel more funding into the real economy.
In terms of, we've talked about potentially European countries could default to extremes or leave the Eurozone. So it brings us on to the UK and a very topical potential referendum after the next election and whether the UK should remain part of the EU. And I know, Howard, you clearly have views on this, but if we can lead with just talking about what you think the benefits are and whether actually the costs would far outweigh those benefits from an exit of the UK from the EU.
Look, clearly there are some benefits for some large companies in certain industries from remaining in the EU. We talked earlier in the room about healthcare, pharma companies benefiting from being able to have one set of regulation, in principle anyway, for all 27 countries. The implementation, I think, is slightly different in different places. But the fundamental problem for the UK is that we need to grow our labour market, as do the rest of Europe, and the labour market is over-regulated. That's partly a function of European legislation. Many of the things that we find within business, whether it's the construction industry or pick any industry you like, the excuse is often we would change it, but we can't because of EU law. Now, sometimes government use that as an excuse, and sometimes it's true. But we need, in Europe, to compete with the rest of the world, we need to deregulate. Europe all the time is increasing regulation. Take financial services, which is our #1 industry. This idea of having a levy on transactions, the UK is sitting here debating it. Can you imagine the Germans sitting here debating something that was adverse to the car industry? It's got to be, the trend from Europe is always more and more regulation. We need to go in the opposite direction. And the argument's always put, well, what happens if we leave? Well, think about it. We are very big, unfortunately, net importers in the UK. We're not net exporters to Europe, we're net importers. Do you really think the rest of Europe are going to make the continuation of trade difficult with the UK just because we leave? Could we not have trading agreements with Europe in the way that Switzerland and Norway does? Could we not have a trading agreement with China? Does Singapore suffer because it's not part of a group? Does Switzerland suffer? Does Norway suffer? The answer is no. In the UK's case, we are a net importer. Europe needs us more than we need them. We also have net fiscal transfers, which are not huge but not insignificant. They're 7 or 8 billion a year. They're going to grow. So it's clear to me that the UK would be much better off from an economic point of view in leaving the European Union. Politically, it's a different point. That's everybody's got their own take on whether that's a good thing or a bad thing.
Peter, can I just come to you as a European industrialist? Do you think, is it actually an opportunity for you if the UK left, having big UK competitors in your industry?
Well, I think the answer is probably it depends how. By the way, you were talking about trade balance and exporter and importer. I just remind the audience that European pharmaceutical industry actually creates a trade surplus of roughly 55 to 60 billion euros a year, just to be said also to European politicians, I think. But if you take, for example, what you alluded to is regulatory pathways. So for our industry, it's a long, painful, hazardous, and expensive process, to develop new drugs, to get the regulatory clearance, to get them registered, and then ultimately it even becomes more difficult to get a decent price and a reimbursement for it. But one thing that is good about Europe, that you have one single European, it's called the European Medicines Agency, based in London, by the way. Once you get that one European registration, it is applicable to all the 27 member states. Now, the question is, what do you do in Switzerland, what do you do in Norway? And more or less, they follow the European Medicines Agency. So that's an example where harmonization and one single body in Europe has actually helped us a lot, rather than to have 27 different files to be submitted and so on and so forth. Now, I can give you, for each positive example, I can give you probably 2 negative examples where Europe is really, creating a lot of burden. I can give you one single one. I think most pharma companies in Europe would be ready to go for a tiered pricing system based on wealth of a country. So I think most companies would perfectly ready to say, if I get a price in Germany of, let's say, 100 for my new product, I give it to the Romanians at the price 50, because for us it's extremely important that you get access to all this new innovation for all the reasons I explained to you. The problem is, of course, that there is a whole series of pricing mechanisms and pricing references that will bring you very, very quickly to the Romanian price all over Europe, right? Then there is another thing which is a complete aberration, which is, per se, free transportation of goods is a good thing, but for pharmaceutical products, where you're in a regulated price environment, it creates complete distortions, because you get a whole bunch of parallel trade if you price your products differentially. As a result of all this, it is a fact that in countries like Romania, Bulgaria, who are a full member of the European Union, access to innovation is completely hampered by that. So it's really a very nuanced picture, I would say.
Okay. And other views in terms of the UK? You think its benefits outweigh the negatives?
I haven't got any comment to make on this issue. This is a political issue. So
it's also an economic issue in terms of whether the benefits. So clearly there are politics involved.
But that's, our ratings do not address this type of risk, and certainly not a 2018 referendum, if there is a 2018 referendum. So I'm not going to answer that question, if you allow me.
Sorry, there's a question over here. So.
Yeah, I had a question for Mr. Shore, who made a pretty strong argument for how Europe needs the UK more than the UK needs Europe. I would just ask that question, though, in the context of the following. Has not the London as the financial center of Europe been a big benefit to the economy of the UK?
Sure.
And if the UK were to exit, could not a pretty good case be made for the city of London becoming much less important as a financial center, maybe that moving to Frankfurt or somewhere else?
Well, I think most people would say that to the extent that we're losing market share is going to new places like perhaps Singapore, Hong Kong, Dubai. Why? You have to ask yourself why. One easy answer is regulation and ease of doing business. The city is a success story because of the depth of the infrastructure, the depth of talent, the history, the culture, the law, the English language, the time zone, the aggregation of all the banks here, so we've got the critical mass. I don't believe for a minute that if we left the EU, we'd lose that benefit. But I do think that we'd be able to regulate our system to best foster the interests of the City of London. It's clear to me that the French governments and German governments are jealous of the City of London, partly for political reasons, because it plays to the electorate, all bankers are bad. And they're quite prepared to hurt our interests. We need to defend our interests, and we're better off defending our interests without them interfering, it seems to me.
So, Andrew, from an investment point of view, do you think that you would view it as a negative if the UK was to leave the EU?
It's a stretch to get there. I mean, the one thing I would say in response to Howard's view is, and I don't have a strong feeling on this, it's just the counterpoint to your really valid point is just that perhaps the best way to protect your interests is to make sure that you have a seat at the table when the EU is making rules. But again, that's I'm not prepared to back up the, that stance, vehemently. It's not an easy issue. It's not an easy issue. From an investment standpoint, big picture, you got to think of it as, actually, this is an interesting example where you have to separate the macro from the micro. And I agree with, Howard's overall point that, it's whether the UK economy stays in or out isn't the thing that's going to decide whether or not McDonald's sells more or less cheeseburgers, or, and that's a bad example because it's, not a UK company, but that's the right way to think about it from an investment standpoint. How are the companies going to fare? Clearly, there are some company and industry specific implications, but broadly in aggregate, that's not going to be a determinant of the long-term success of investors.
Okay. And just from an investment point of view, where do you think the opportunities are in Europe today from your perspective?
Yeah, interesting. The thing that happened when the European crisis was in full swing, and this is just one of these nerdy things that we look at JP Morgan, is the correlation of different asset classes, and even within asset classes, they all went up. Everybody was doing what I call the GMT-HO trade, which just stands for get me the heck out. Everybody wanted cash. We talked about that back there. And so when everybody wants cash, they sell everything, and the correlation of everything goes up because the price of everything is going down. And so there's been some bounce back in the last few years. But if you look at a stock market, for example, like Spain, it would have to return 115% just to get back to where it was before the crisis. And it's already come 40% or 50% off the bottom. And so I think there has been a lot of babies thrown out with the bathwater. And so in terms of investing, I think you can do really well in Europe broadly in the stock market. This is a self-serving comment coming from JP Morgan Asset Management, but I say it with hand on heart. You won't win the game, though, if you're doing it at the index level. Not all companies are going to benefit from this recovery in the same way. You've got to be able to, and I'm not saying that necessarily JP Morgan can do it better than our competitors. I think we can, but the point is you have to be selective, and it gets into an industry thing. One thing that I would agree with is that there's one thing that people are always going to be willing to spend their last euro on or their last pound on is to live a little bit longer. And so we always see healthcare as an opportunity, and also there's going to be a shift from the defensive sectors to the more cyclical ones as Europe moves from getting worse and worse to getting less bad, technology, industrials, and things like that.
Okay, from an American point of view, do you think the kind of opinion has changed in terms of Europe as a basket case against Europe as an investable proposition?
Yes, I think it has from a year ago. I think you see much more investment from Americans in Europe now on the private equity side, I think, in the UK in particular. Also from the point of equities themselves, that they certainly look better from a relative value point of view here in Europe than they do in the US, whether you look at it from sort of a PE ratio or book value. The fixed income side may be a little different. Take up Howard's point just a little bit. If you all of a sudden have defaults here, that's certainly not good for fixed income investors, and particularly the banks here, because banks hold many of the fixed income assets here, particularly government debt. And when you look at it relative to the United States, I mean, European banks hold 3 or 4 times more government debt than U.S. banks hold of U.S. debt.
And Howard, clearly you have some European investments. Is this a kind of area that you think is investable today, given the kind of political and economic problems you've talked about earlier?
Well, at a business level, at a personal level, I'm very long German real estate, particularly residential. It's a market that I believe has got a lot of growth opportunity coming from an unusually low level by comparison with other price levels in other major economies. It also benefits from the fact that it's an inflation hedge.
There's an income component to it.
There's an income component to it. It's an inflation hedge, and we feel pretty confident about the residential prospects. We also think that the German economy, despite these pressures to support Europe, is reasonably stable, and ultimately, if the euro did break up, and I'm not predicting it does in the near term, but if it does, and we get a Deutschmark back, of course we make a killing overnight, because we all know what would happen to the German currency if the euro breaks up, even to any degree. If some of the weaker nations leave, what happens to the rest of the euro currency? So we feel pretty comfortable about being invested in that sector of the German economy.
And Peter, from an industrial point of view, are there the areas of Europe you're keen on investing in, with a kind of disparity now in labour rates and the other things we've been discussing?
Well, I think that where we're really willing to invest is where access to innovation is respected, and the contradiction is that many countries have programs to stimulate R&D in a given country. You have things like the patent box in the UK, you have the Crédit Impôt Recherche in France. So there's a lot of stimulation to keep research and development within Europe. The issue is that more and more European countries, under the pressure of fiscal consolidation, once the result of that R&D in Europe becomes available in the form of a new innovative product, that they say, well, we'll see whether we can fund it and what price, et cetera, et cetera. And you see a completely different attitude still today in the US towards embracing innovation. So my answer to your question is, I would go in those countries where uptake of innovation, access to innovation, is still valued at a decent price. And that's where I would go. And if that's not in Europe, it will be outside of Europe. And
do you think there's specific countries in Europe that you think are more favourable than others from that perspective?
Well, they're all quite difficult, to be honest with you today. But no, some still value, and it depends a bit. And the systems are very different, the way you get prices and reimbursement for new drugs. The UK is a bit of a difficult one for certain therapeutic classes, but then in other therapeutic classes, now I'm becoming very granular here, but in other therapeutic classes they're better off. So it's very difficult to answer your question black and white.
From my side, if there is one segment of the market that is worth investing in, particularly from the point of view of EU institutional investors, it's the private placement market, which is vibrant in the US. Does not exist in Europe. The biggest chunk is the German Schuldscheine market, which could be replicated elsewhere. Actually, a couple of months ago at S&P, we launched a new credit benchmark targeting those institutional investors who want to buy more private placement paper from mid-sized corporates from Europe. And we think that we can really help bringing more transparency and comparability to that market, which again is vibrant in the US, does not exist in the EU, and could go a long way towards channeling more funds into the real economy.
Okay, thank you. I think with that, we're out of time. I'd just like to thank the panel for a very interesting discussion, one with differing views, and I think we all seem to be agreed that the EU's now not out of the woods yet, but we're seeing some signs of recovery. But thank you.
Thank you.
Ladies and gentlemen, lunch will now be served on level 31. Please make your way to level 31 via the lifts or staircases.